You've probably heard that the backdoor Roth IRA is the ultimate tax hack for high earners. Put money in, watch it grow tax-free, pull it out in retirement completely clean. Sounds perfect. But if you're a freelancer making good money, that strategy might be quietly costing you more than you realize, and nobody in your tax prep software is going to warn you about it. So here's what this video is actually about. The backdoor Roth IRA has some serious hidden landmines that most financial content completely ignores, and when you stack them together, they can push your real tax rate on a single conversion to 55.9%. That's not a typo, and I'm going to walk you through the ones that matter most, starting with the trap that catches almost every high-earning freelancer off guard. The first thing you need to understand is the pro rata rule, and it's the one that quietly destroys the whole backdoor strategy before it even gets started. Here's how it works. Let's say you have $100,000 sitting in an old rollover IRA from a previous job. Super common for freelancers who've bounced between gigs and employers. You make a $7,000 non-deductible contribution and try to convert just that $7,000 into a Roth. Seems clean, right? You're only converting the new money. But the IRS doesn't see it that way. They look at every traditional IRA you own, every rollover IRA, every SEP IRA, every simple IRA, and they treat it all as one giant pool. So when you go to convert that $7,000, they say 93.5% of that conversion is pre-tax money. You're not converting $7,000 of clean after-tax dollars. You're converting a blend, and you owe taxes on almost all of it. The backdoor move you thought was clever just became a tax bill you didn't see coming. The fix is real, but it has a deadline. If your current employer's 401k plan accepts incoming rollovers, you can move all that pre-tax IRA money into the 401k before the end of the year. That clears the pool, and then your backdoor conversion actually works the way it's supposed to. But if you don't do that first, you're not doing a backdoor Roth. You're just paying taxes on money you thought was already handled. Now here's where it gets more interesting, because the pro rata trap is just the entry point. The bigger issue is what happens when the conversion actually goes through and starts colliding with other parts of the tax code at the same time. There's something called the tax torpedo, and it's the reason that 55.9% number in the title isn't an exaggeration. Picture a married couple, both 65, living mostly on Social Security with some investment income on the side. They look at their situation and think, we're in the 12% bracket, this is the perfect time to do a modest Roth conversion. So they convert $60,000. Seems reasonable. But when you actually model out what happens to that $60,000, the effective marginal rate on that chunk of income comes out to 55.9%. The reason is that extra income doesn't just get taxed once. Conversion calculators never factor this in. They show you your federal bracket, declare it a win, and move on. But the 2-year look back is exactly why this sneaks up on people. You do the conversion in 2026, feel great about it, and then get blindsided by your 2028 Medicare bill. And if you're a freelancer using the QBI deduction, the 20% pass-through deduction for self-employed people, a large Roth conversion can wipe that out too. If your income crosses the phase-out threshold because of the conversion, you can lose a deduction worth $20,000 to $40,000 a year, depending on your income. That's an extra $6,000 to $15,000 in federal tax that nobody's Roth calculator is accounting for, because most of them don't even ask if you're a business owner. So at this point, you're stacking the pro rata mess, the tax torpedo effect, IRMA surcharges 2 years out, and the QBI phase-out, and none of these show up as line items when you're sitting there thinking about whether to do a conversion this year. Here's the one that tends to really change how people think about this whole strategy. Capital gains harvesting is often a better move than a Roth conversion, and the two strategies compete for the exact same bracket space. If your taxable income stays inside the 0% long-term capital gains bracket, which goes up to $98,900 for married couples filing jointly, you can harvest gains at 0%. Zero. And even if you're above that, capital gains are taxed at 15% for most high earners, all the way up to $545,500 in taxable income for a single filer. But when you do a Roth conversion, that ordinary income crowds out your cent capital gains, space dollar for dollar. A $100,000 Roth conversion might cost you $22,000 in taxes. Harvesting $100,000 in gains while staying in the 0% bracket costs you nothing. And yet most advisors lead with Roth conversions without even asking whether capital gains harvesting would be more efficient first. The math isn't always close. Sometimes it's not even a competition. If you're finding this useful, drop a comment below and tell me which of these you had no idea about. The algorithm loves it, and honestly, it helps me know which of these topics to go deeper on. And if you haven't subscribed yet, this is the kind of content I put out regularly, the stuff that doesn't usually make it into a 60-second reel. Now, one more thing that almost nobody talks about, and it matters especially if part of your reason for doing a Roth is to leave something behind for your kids. If your heirs are high-income earners and they inherit a traditional IRA, they can end up paying 46 to 49% on it when it gets compressed into trust tax brackets. So the thinking is, I'll convert now, pay my 32%, and hand them a tax-free Roth. That sounds generous. But if your heirs are actually in a lower tax bracket than you, it might be mathematically smarter to leave the money in the traditional IRA and let them pay taxes at their lower rate later. You converting at 32% to save them taxes, when they would have paid 22%, means you made it worse. The math runs against the instinct here, and it's worth actually modeling it with someone who'll do the real numbers. And here's the final piece, because the whole conversation might be moot depending on what Congress does. There is proposed legislation that would eliminate the backdoor Roth strategy entirely, potentially as early as 2026. The specific provision would prohibit after-tax traditional IRA contributions from being converted to Roth IRAs, which is the exact mechanism the backdoor strategy relies on. If that passes, the window closes, and all the complex planning you did to set it up becomes irrelevant overnight. So where does that leave you? The backdoor Roth isn't automatically bad, but it's also not the clean, simple tax win it gets marketed as, especially for freelancers with existing IRA balances, QBI deductions, capital gains to harvest, or any proximity to Medicare age. The real question isn't, should I do a backdoor Roth? It's, what does my actual marginal rate look like when I account for every rule that applies to me simultaneously? Because if you're paying 35.3% in California, losing your QBI deduction, triggering an IRA surcharge 2 years out, and missing out on 0% capital gains harvesting, the tax-free growth you're chasing might cost more to get than it ever gives back. Run the full model. Not just the bracket. The full model. And if you want to see exactly how capital gains harvesting stacks up against Roth conversions in a real scenario, I put together a video on that specifically. It's linked right here, and it's worth watching before you make any moves this year.